Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So in today's video, we're going to be talking through the top 3 investment lessons that I have learned from one of my favorite investors and someone who you hopefully all know by now, and that is a guy by the name of Mohnish Pabrai. Now, I want you to treat this video a little bit like a pilot episode of your new favorite Netflix show, and let me know down in the comments below if you'd like me to turn this into a bit of a series so that you can see sort of my perspective on the top 3 investment lessons that I've learned from all of my favorite investors. So if you want to see a video like this on someone like Warren Buffett or Guy Spear or Phil Town or Joel Greenblatt or Bill Ackman or any of those investors or any investors that you might be following, then hit like on the video, tell me in the comments down below who you'd like to see next, and I can definitely put that video together. But for now, let's get straight into my top 3 lessons from none other than Mohnish Pabrai. Now, the first lesson I have learned from Mohnish Pabrai, and certainly the one that has been very powerful for me in terms of being able to scan through and analyze a large number of companies a lot quicker than I've been able to in the past, is to focus on finding reasons not to invest in businesses, trying to say no to companies as fast as possible. And the way Mohnish Pabrai describes this himself is he looks at a couple of metrics, basic metrics on the company. Is it a PE of 1? No. Then he'll say no to that business. And it's not quite that simple, but effectively he's looking for really heavily discounted businesses, and he's trying to buy at massive discounts to intrinsic value. So if Pabrai is to look at something like Amazon or something like Netflix that trades at a very high PE multiple in the case of both of those companies, or a business that has no free cash flow in the case of Netflix, that's basically an automatic pass for Mohnish Pabrai, and it allows him to keep moving on to more and more businesses and more businesses. And his process of basically finding a business that he does make an investment in is a little bit kind of inverted to the way people usually look at companies. So generally, when a lot of newer investors in particular are reading through maybe an annual report or listening to a conference call or just trying to understand a business in the first place, one of the things they're really looking to do, even if it's just subconsciously, is find really great positives about this business and try to put together some sort of narrative around why this is going to be a really successful investment, where I think it pays in investing to be a little bit more pessimistic sometimes about how individual businesses will perform. And that can really protect you from downside, and it can keep you away from, again, the high flyers, high valuation type businesses where traditionally the long-term returns have not been very good. So that's the first lesson from Mohnish Pabrai, is to eliminate businesses as fast as possible, keep moving on to the next one or getting back to general reading. And by the time you find a business that you cannot find any reason whatsoever not to invest in it, it should be looking like a pretty promising candidate for making a new investment. Now, the second lesson I've learned from Mohnish Pabrai, and arguably his most famous investment lesson, is to focus on businesses that have this unusual combination of low risk and high uncertainty. Now, what that essentially means is, first, in terms of low risk, we want to have a business or an investment that really has quite a minimal risk of losing money, permanent loss of capital. That's really how we define risk as a value investor. We don't define it as volatility or the stock just moving up and down a lot. We really want to focus on the underlying business running into issues that are going to mean that either the company goes bankrupt or it has a dramatic long-term drop, a permanent drop in its long-term cash flows, which again, in both of those scenarios, leads us to being quite likely to lose money. So there's a couple of things that we can do to protect ourselves in terms of risk. One of them is making sure that the business always has some sort of base level of cash flows that keeps the business alive, first of all, and also guarantees some sort of reasonable rate of return as investors. And the second thing we can do is we can buy it at a really cheap price. So when you invest in a business, the likely returns that you get are all really dependent on 2 things. Firstly, how much cash can that business produce over a long period of time and return to you as a shareholder? And secondly, how much do you pay for that business? So again, I love to use the rental property example on this channel, but if you have a rental property that produces $10,000 a year in free cash flow, and you can buy that property for $100,000, that is going to be in and around a 10% return. Now, if something goes wrong, maybe you have higher vacancy rates than expected, and that free cash flow drops down to say $5,000, all of a sudden your return is only 5% and looks much less attractive. But as value investors, if we can look for these really discounted businesses and buy that same house that produces $10,000 a year in cash flows and buy it for like $30,000, which again, we're not able to actually buy houses like that, certainly not here in New Zealand at least. But if we can buy businesses with those sorts of characteristics, then the bar or the threshold in terms of cash flows that company has to produce in order for us to make a reasonable return and to not lose money, the threshold or that bar drops down very, very low, a lot lower than if we'd paid up a full price for that business. So that's the first thing with low risk. And this unique combination of low risk and high uncertainty can create the situation where it's very unlikely that we lose money, but there's sort of this built-in, almost a free lottery ticket, as Pabrai describes it, where we can potentially have a lot of upside. So the classic Pabrai investment in this case is a business by the name of IPSCO. And if you may have heard me talk about this on the channel before, but I'll go through it again. Now, IPSCO was a tubular steel manufacturer and a company that Pabrai invested in the early 2000s. And if you know nothing about the steel industry, all you really need to know for this example is that the steel industry is very, very cyclical, which means it goes through massive swings of great profitability and massive losses, and it's very unpredictable. So definitely a high uncertainty business in terms of what the cash flows are likely to look like. But in the case of IPSCO, we had some unique sort of situations. So first of all, we had a company that had $15 a share in cash and no debt. So the balance sheet was looking rather healthy, and we had $15 a share in cash. The next thing that we had with IPSCO was that over the next 2 years, IPSCO had actually contracted or pre-sold all of their tubular steel for the next 2 years, and they had quite well-known costs alongside that sort of guaranteed revenue, and they could guarantee, or as close to guarantee as you can in this sort of industry, that they were going to produce about $15 per share in free cash flows each year for the next 2 years. So if we fast forward 3 years, we're going to have $45 in the bank, no debt, and IPSCO at the time was trading at $45 a share. So put those things together and we have very, very low risk. Now, what we do have is very high uncertainty in terms of what happens after year 2. So after year 2, IPSCO could very well get into a position where it's losing money or maybe still making money. We just have no idea because of the nature of the steel industry. And the way that this investment worked out in the end is that after 2 years, they did produce the $15 a share in cash flows each year. And then they came out and said, actually, we've got another year or another 2 years of visibility on these cash flows. And what happened in terms of the valuation as these earnings became more steady over time is that we had this combination of low risk and high uncertainty, and that worked out very, very well in terms of investment returns. So eventually IPSCO was bought out for somewhere near $150 a share. Mohnish Pabrai sold out basically as soon as that news came out, and he made roughly a 3x on that investment. So that's the second lesson from Pabrai, is focus on a unique combination of low risk and high uncertainty businesses. So the third and final lesson from Mohnish Pabrai is compound 26, and some of you may already know what this means, but I'm going to put up a picture of Mohnish Pabrai's number plate on his BMW here, and I'm not a huge BMW fan or a BMW driver, but Mohnish Pabrai is, and this compound 26 personalized plate is basically a reminder to himself of his mission on his investing kind of journey. So if you don't know Pabrai's story, the reason he got into investing in the first place was he sold off a large portion of ownership in his IT services business. For the first time, he had a spare $1 million, as he put it, and he put that $1 million into value investing, into the stock market, following a very Warren Buffett style approach. after learning about Buffett in the 90s, and that's kind of where he got his start. And he had this mental model of being able to compound money at 26% a year, and if he could do that, that means he doubles his money every 3 years, and if he did that over a period of 30 years, that works out as 10 doubles. 10 doubles would turn $1 into $1,024. If we take away the 24 and kind of simplify the maths, that would allow Mohnish Pabrai to turn his million into $1 billion in 30 years. And that was sort of Mohnish Pabrai's overall initial goal. He said, it's a bit of a stretch target, but let's kind of see how we go. And, even if it doesn't work all that great, maybe we only get to $500 million. $500 million is still a hell of a lot more than $1 million. So that is Mohnish Pabrai's sort of goal and mental model. I just want to briefly talk through the way that he thought through actually finding investments that would help him meet this criteria to continue compounding money at such a high rate of return over a long period of time. Now, the mental model or the original investment framework to allow that high rate of return is actually very, very simple. And it was basically this. It was basically to buy $1 worth of value for 50 cents in terms of price. And this is something that we talk about all the time on the channel, and it's really my core investment framework as well, is to find a business that we can calculate intrinsic value for, or at least we can find this low risk, high uncertainty combination where we know at the very least where the floor of valuation is. Maybe we don't know what the upside is, but we certainly know where our downside is, and we can keep track of that. And Mohnish Pabrai had this investment model where if he can find something worth $1, buy it for 50 cents, and it appreciates back to $1 over, say, 3 years in this example, then that works out at a double every 3 years, and that is 26% a year, pretty much right on the dot. And he sort of had this model where in some situations investments may get back to intrinsic value quicker than that. Maybe they do it in a year and he gets 100% rate of return on that particular stock. Maybe it takes 5 years and that works out at a 15% per year return. But overall, his mental model was basically, if I can buy a small basket of businesses that are trading for half of what they're really worth after doing deep analysis on those particular companies, and on average they appreciate to intrinsic value every 3 years, then that is a 26% rate of return, and that is the sort of method of him getting to the promised land, as he might put it. Now, those are my top 3 lessons on investing from Mohnish Pabrai. He is definitely one of my favorite investors to follow, and I will be continuing to follow him for a long period of time, that is for sure. So if you did enjoy the video, please hit like, hit subscribe. If you think there's anything I've missed with Pabrai in terms of major investment lessons, definitely drop them down in the comments below. And I'm really keen to hear your thoughts on this type of video in general. And just let me know whether you'd like me to do more of these. So if you'd like to see a Buffett top 3 lessons, or a Charlie Munger, or any other investor that I often talk about on the channel, drop that down in the comments below. Let me know, and I can certainly put those videos together. So that's all from me today. If you do want to watch some older videos, you can do so by clicking over here. If you want to hit subscribe and haven't already, I would very much appreciate that, and you can do that over here. But that's all from me today, and I will see you in the next one. Cheers.